In 1907, the United States did not have a central bank, no Federal Reserve, no emergency backstop, no printed liquidity on demand. When panic hit, there was no number to call in Washington. There was just one man. And when the American financial system began to collapse, that man, J.P. Morgan, didn't issue a press release. He locked the bankers of New York inside his library and refused to let them leave. This is not mythology. This is how modern central banking was born, and it matters today more than most people realize. The Panic of 1907 wasn't just a market crash. It was a live experiment in what happens when a financial system built on confidence suddenly runs out of it. The solution wasn't a policy committee or a bailout package. It was a private citizen with enough power, connections, and personal credibility to act as the lender of last resort for an entire country. But to understand how one man could save the U.S. economy, you have to understand how fragile the system really was. At the start of the 20th century, America's banking system was decentralized and chaotic by design. Thousands of small banks were scattered across the country. Reserves were fragmented. There was no unified authority coordinating liquidity. Money itself was elastic in theory but rigid in practice. Then there were trust companies. Trust companies were the financial innovators of their time. Less regulated than traditional banks, they paid higher interest, took bigger risks, and held lower reserves. They were shadow banks before we had that term. Investors loved them. Depositors trusted them until they didn't. The spark came in October 1907. Two speculators attempted to corner the market in United Copper Company stock. The scheme failed spectacularly. The stock collapsed. The brokerage houses tied to the scheme fell with it. Financial systems are webs. Pull one thread and tension spreads everywhere. One of the men behind the failed scheme had close ties to the Knickerbocker Trust Company, one of New York's largest trust institutions. Rumors started. Depositors lined up. Within days, Knickerbocker faced a classic bank run. And unlike today, there was no FDIC insurance, no guaranteed deposits. If you were early in line, you got your money. If you were late, you didn't. The run on Knickerbocker triggered something more dangerous than insolvency. It triggered fear. Other trust companies began to wobble. Banks stopped lending to each other. The stock market fell nearly 50% from its peak. Call money rates, short-term loans brokers used to finance stock purchases, spiked to 70%. At one point, trades on the New York Stock Exchange were on the verge of halting entirely because there simply wasn't enough cash in the system to settle transactions. Liquidity vanished. And liquidity, more than profit, is what keeps finance alive. This was the moment where, in modern times, a central bank would step in. It would inject reserves, calm markets, coordinate banks, and act as lender of last resort. But in 1907, there was no such institution. So the bankers went to Morgan. John Pierpont Morgan was 70 years old, towering, physically imposing, with a nose broken in youth that gave his face a permanent severity. He controlled vast railroads, steel companies, and banking interests. He was not just rich. He was systemically important before the phrase existed. More importantly, he had something rarer than money, credibility. Morgan understood something fundamental about panics. They are not purely financial events. They are psychological events with financial consequences. If depositors believe banks will fail, they fail. If markets believe liquidity will disappear, it does. So Morgan began doing what a central banker does. First, he assessed solvency. He and his team examined the books of troubled institutions overnight by lamplight in his library. If a trust company was merely illiquid but solvent, he organized support. If it was rotten, he let it collapse. He created a private clearinghouse of capital. He persuaded major banks to pool their reserves. He directed money into institutions facing runs. He personally pledged funds when necessary. At one critical moment, the New York Stock Exchange itself was hours from closing. If it did, panic would explode nationwide. Morgan assembled the leading bankers in his study and informed them that $25 million was needed immediately to stabilize the market, roughly $800 million today. The bankers hesitated. Morgan did not. He told them they would subscribe the funds. Then he closed the doors. The story goes that no one left until the money was committed. Was it coercion, leadership, theater, maybe all three? But it worked. The funds were raised, the exchange stayed open. Confidence flickered back to life. And here's the uncomfortable part. Morgan wasn't acting out of pure public spirit. He had massive financial interests tied to the stability of the system. If the banks collapsed, so would the railroads, the industrial giants, and the securities he underwrote. Saving the system also meant saving himself. But in doing so, he performed a function the U.S. government simply could not. He became the lender of last resort. The panic didn't end overnight. Runs continued, more institutions faltered. But the coordinated injection of liquidity slowed the bleeding. By November, the worst had passed. Americans were left with a strange realization. Their entire financial system had depended on the judgment, reputation, and balance sheet of a single private individual. Not a public institution, not an elected body, but one man in a library on Madison Avenue. That realization was both reassuring and terrifying. Because what happens next time? If there is no Morgan? That question lingered long after the panic faded. Because 1907 revealed something most Americans had never confronted. The United States was an economic superpower with a financial system held together by improvisation and personality. Europe had central banks. The Bank of England had been acting as lender of last resort for decades. The Reichsbank in Germany could expand credit during crises. Even smaller nations understood that modern industrial economies required a coordinated monetary authority. America had J.P. Morgan, and Morgan was mortal. The panic of 1907 didn't just scare depositors, it embarrassed policymakers. The idea that Wall Street's most powerful banker had to personally orchestrate a rescue exposed a structural weakness. What if Morgan had misjudged solvency? What if he had chosen favorites? What if he had simply refused? The system had survived, but barely. And it had survived because one man decided it should. In 1908, Congress responded with the Aldrich-Vreeland Act. It was a temporary patch, allowing banks to issue emergency currency during crises. More importantly, it created the National Monetary Commission to study European central banking models. Translation: Washington had realized it needed its own J.P. Morgan, but institutionalized. Over the next several years, a quiet transformation unfolded. Senators met with bankers, economists drafted blueprints, powerful financial figures, including some of Morgan's own associates, helped design what would become the Federal Reserve System. The irony is almost too perfect. The Panic of 1907 is often told as a heroic story of private capitalism saving itself. But its true legacy was the birth of centralized monetary authority. Morgan's success made it obvious that the function he performed could not remain private. He had proven the necessity of a lender of last resort. He had also proven the danger of relying on one. When the Federal Reserve was created in 1913, it was designed to diffuse power geographically. 12 regional reserve banks instead of one dominant institution. It was a political compromise meant to avoid concentrating too much control in New York. The memory of Morgan's dominance was still fresh. But make no mistake, the Fed inherited his role. During every major crisis since, the Great Depression, 2008, 2020, the Federal Reserve has acted in ways that echo 1907. It assesses solvency. It injects liquidity. It backstops markets not because every institution deserves saving, but because confidence itself must be stabilized. The playbook was written in Morgan's library. Yet there's a deeper layer to this story, one that doesn't fit neatly into hero narratives. Morgan didn't just stop panic, he consolidated power. In the years surrounding 1907, Wall Street was dominated by a small network of financiers, Morgan among them, who sat on interlocking boards of railroads, banks, and industrial firms. They allocated capital, influenced policy, and shaped entire industries. The crisis gave Morgan leverage. Institutions that needed rescue often became more tightly linked to his sphere of influence. Stability came at a cost. Concentration. This duality is uncomfortable. On one hand, Morgan prevented a financial collapse that could have spiraled into depression. On the other, the episode reinforced public suspicion that too much economic power rested in too few hands. That suspicion eventually fueled the Progressive era's antitrust movement. It shaped investigations into the money trust. It even influenced how aggressively regulators later approached concentrated banking power. Saving the system raised a new fear. Who controls the system? There's also the moral hazard question. If markets believe someone will always step in, whether a powerful banker or a central bank, risk-taking changes. Investors stretch further. Institutions hold thinner buffers. Leverage creeps higher. In 1907, trust companies held lower reserves because competition demanded higher returns. They assumed liquidity would be available when needed. They assumed the system would function. It didn't. And Morgan's intervention, while stabilizing, quietly taught markets another lesson. In extreme cases, extraordinary support might appear. Sound familiar? Fast forward a century. In 2008, the Federal Reserve and Treasury orchestrated rescues of major financial institutions to prevent systemic collapse. In 2020, the Fed expanded its balance sheet by trillions in weeks to stabilize markets during the pandemic shock. Each time, officials argued the same point Morgan understood instinctively: the alternative was worse. Let it all burn, and the economic damage could spread far beyond Wall Street, into factories, payrolls, and households. The logic is pragmatic, almost clinical, but it raises a question that never fully goes away. Where is the line between stabilizing a system and entrenching it? Morgan acted without democratic oversight. He wasn't elected, he wasn't appointed, he answered to no voters. His authority came from wealth and reputation. That concentration of private power unsettled the nation. The Federal Reserve, by contrast, operates within a legal framework, yet it remains insulated from direct political pressure precisely so it can act decisively during crises. In both cases, stability depends on trust in unelected decision-makers. And trust, as 1907 demonstrated, is fragile. When depositors lined up outside Knickerbocker Trust, they weren't analyzing balance sheets. They were reacting to fear. When bankers hesitated in Morgan's library, they weren't calculating optimal capital allocation. They were weighing personal risk. A financial system's run on psychology layered over arithmetic. Remove confidence, and the math stops working. That's why the panic of 1907 still matters. Not because one titan strode in and saved the day, but because it exposed the invisible architecture beneath modern capitalism. The need for liquidity, the speed of contagion, the role of coordinated authority in stopping panic before it feeds on itself. It also exposed something more enduring. In moments of crisis, power concentrates. Whether in the hands of a single banker or a central bank committee, someone must decide which institutions survive, which fail, and how much money to create to calm the storm. In 1907, that someone was J.P. Morgan. He died in 1913, the same year the Federal Reserve was born. The era of private rescue gave way to public mechanism. But the underlying tension never disappeared. Because every time markets wobble and policymakers step in, we are replaying a version of that October night in Morgan's library, when a handful of powerful people decided the fate of an economy behind closed doors. The difference is scale. Today, the numbers are larger. The tools are more sophisticated. The language is more technical. But the core question remains unsettlingly simple. If confidence collapses tomorrow, who locks the doors and who decides when they open?